Hey, it is a great day. Scott Riley, the Market Update Desk, July 11th. We are pleasantly surprised from the inflation numbers that came out. If you remember, there was some concern on specifically the core CPI and where that was going to come in at because we had a pretty low replacement number from last year. So let's break everything down here. So the headline CPI came in at minus 0.1%. So actually deflationary. That's versus expected of plus 1/10. So year over year, we went down from 3.3% to 3%. Now that's really close to a two handle, which is a very important number for the Fed watch. And if we can break that below the three, break it into a two handle, it's going to be very, very important. Core, which was our big concern going into today, was up 0.1%. Now the market was expecting a 0.2 increase. So that was very pleasantly received in the market. We decelerated from 3.4% year over year to 3.3%. And actually, you got to go back in the calendar to April 21 to get a lower core CPI. So we're making some headway. Why did we make some headway here? Let's break this down. Motor vehicle insurance, still the thorn in our side, went up 0.9 year over year now. It's up 19.5%. Shelter, we are finally getting that break we've been waiting for shelter cost within the CPI. In the real world, the rent renewals, those have been coming down for quite some time, but the lag effect of lower rent renewals within the CPI report has dragged on and on and on. We started to see it today. So shelter was up 0.2%, brought the year over year down to 5.2%. That was 0.2 better than expected. Now we're still overweighted in shelter compared to what the real world is, but man, it is a pleasant surprise to start to see this filter through. Used cars helped us out again, down another 1.5% this month, year over year down just a tick over 10%. Airline tickets, those were down 0.5%, year over year down 5.1%. Now, when you take everything else within the breakdown of inflation outside of those four key areas, all other inflation was up just under 0.2, 0.19. What that tells us, the two categories that are there controlling where we are in inflation are shelter costs and motor vehicle. And we're starting to get better shelter cost numbers. So I think we're going to start to see that come down. Lodging away from home, which decreased, and airline tickets, which we just discussed, decreased, is showing this pattern of a slowdown in the economy. Now we're hoping the Fed and Chair Powell recognize this of the slowing economy. This plus other factors, the weaker job numbers, and even weaker when you get into the meat and potatoes of the jobs numbers post revisions, it's showing us that we are decelerating in the economy, and it's time to start talking about rate cuts. Jobless claims is the other one that came out today. Initial claims that fell quite a bit to a little over 230,000 and dropped 17,000. But there's always an asterisk here. That was on a holiday week last week, and the BLS doesn't have a good formula to factor in those short holiday weeks. So we're expecting next week's are probably going to get back to the pattern we've been seeing of the 250 plus jobless claims. Continuing claims remained very elevated still at 1.85 million. That was down 4,000, but in reality, remember, it was a shorter holiday week. We had a 10-year bond auction. And this is also what's helping us today. That was graded a B+. So we've had about 2 weeks worth of positive bond auctions. Today we get another one. Let's hope we get this pattern rolling and continuing. Looks like institutional and foreign investors are still are being very positive to our bond market. Now, I did make a note. Today we crossed under 4.18. Technically 4.183 on the 10-year. Lowest we've been since probably back in late April. If we can close under 4.21, we've got a little bit of a runway down to about 4.07 on the 10-year bond. That's going to help us out with rates. Also, mortgage-backed securities are rallying today on this kind of unexpected news. So this is all great information. Tomorrow, now keep in mind, we get the wholesale inflation, or the PPI, producer price index. That's going to hold some weight with the bond traders. And at this point, you need to be cautious depending where we close. Are some profits going to be taken off the table from some of the bond traders, which would kind of take away some of our gains. Next week's also going to be very important. We do get the PCE report, personal consumption expenditures. Now, what's going to be really interesting, the September PCE report that we get, which would be the August numbers in September, has a very high number that we're going to be dropping off. If we can get sustained deceleration on inflation through CPI, PPI flow into PCE, we're going to have some really good trajectories here for maybe sub 4% on the 10-year Treasury. Now, this information, on top of the weak job numbers from last week, has really started the market abuzz. Could we potentially get a rate cut in July? Yeah, realistically not. Fed's not going to want to move that quickly. They're going to want probably one more report to show sustainability. But the betting odds for a September rate cut, I think, went up and over 78% now. So these are all great information. We'll keep you up to date. We'll put a chart up of the numbers from the CPI breakdown. Give us a call. We'll help explain all this and help you with your mortgage approvals and getting offers accepted. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan. 616-293-2189. Have a great day.